Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 4th of December. I'm Daniel Lam, your host for the podcast. With all the hype back in late September and early October, Hong Kong China equities have given up most of the gains since then, and it is trading in a tight range. The volatility for the Hang Seng Index has been halved, as evidenced by the VHSI Index moving from over 40% to the more normal 20%. Investors have turned cautious on Hong Kong China equities because US policies, such as the tariff, are making the headlines. Now, by themselves, they could have a limited direct impact on Chinese equities earnings, given they generate most of their income domestically, estimated to be close to 90% of the total MSCI China revenue. Also, back in Trump 1.0, China managed to gain percentage share of global exports by offsetting the loss of exports to the US, with expanding their exports to other markets. However, the indirect impact on consumer and business sentiment, as well as access to technology or supply chains, are likely to impact Chinese equities. To offset these, we expect Chinese policymakers to roll out more stimulus, with details possibly forthcoming at the Central Economic Work Conference later this month. However, we believe policymakers may prefer to calibrate the size of any stimulus after US policy details are shown, likely only after Trump's inauguration. Furthermore, China may strive to achieve a negotiated outcome with the Trump administration. With the macro situation turning more hawkish against China, perhaps it would come as a surprise that the significant inflows we saw from local and foreign investors around the national holiday period have yet to unwind in a meaningful size. So this suggests that there could still be some hopes of China's stimulus on the horizon. Moreover, positioning for the worst-case scenario on tariff has not taken place either. So the risk is that headlines over the next couple of months related to tariffs and an absence of fiscal response from Chinese authorities could see a further clearing out of these China equity longs from foreign investors. So therefore, it is important for investors to use a barbell strategy in China with our buy views on non-financial high-dividend SOEs for income stability. We focus on non-financial subsector which are less exposed to the property sector. Also, look at the Hang Seng technology sector for valuation re-rating when more policy stimulus is rolled out. Companies in this sector generate strong cash flow, which are used for share buyback. So this barbell approach would provide exposure to income stability, along with high beta gains when China shows more stimulus. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.